What's up, everyone, and welcome to the Daily Macro Update for Thursday, November 13th. My name is Johnny Zerdy. Taking a look at the macro data for today, obviously the big news is that Trump signed the bill to end the 43-day record government shutdown. But why have stocks gone down? We're going to go ahead and be covering that in this video today. If you guys appreciate this type of macro content, please consider subscribing to the channel, sharing this with a friend. That way we can keep this going. Appreciate everyone joining here today, and let's go ahead and get right into it. So yeah, I mean, in terms of the macro data, we were supposed to get CPI today, but as we saw the other day, yesterday actually, we saw that Caroline Leavitt went on TV saying that, oh, you know, the Democrats could have permanent damage with the data that came out for inflation in October and September, and we'll probably never get that data, which doesn't make any type of sense because all you need to do is just complete the surveys. But hey, you know, that's what they're saying. We're just going to roll with it. You don't necessarily need it in order to effectively manage your positions, but we'll go ahead and take a look at that data here. But looking at the S&P 500, where we have a pretty decent drop here, we have about 12 minutes left before the market closes. Taking a look at the trading ranges for today heading into the close, we can see that, you know, it's still pretty close to the mid-range right now. The S&P 500 has not broken its bullish trend. As you can see behind me, the bookshelf is green. And so for those that are new to the channel, whenever the bookshelf, whatever the color is on the bookshelf behind me, is the current trend with the S&P 500, and it remains bullish. So there's nothing really to do except for buy, as long as volume is also declining. When we take a look at volume for the S&P 500 today, we were seeing a little bit of an acceleration here compared to the last 2 days. And so really what we like to see is a red day on lower volume. So not necessarily trying to add to anything too aggressively as we have a ramp up in volume on this sell-off here. And it's okay. Sometimes you just want to be patient for specific things to give a decent opportunity. And so what a lot of people were expecting is, you know, if the government ends up opening up instead of being shut down, that would allow the stocks to rally as well as Bitcoin to come back. But the opposite has kind of happened. And the reason is not because of anything that has to do with the government shutdown. It really has to do with something that we've been talking about that is totally separate, which is inflation expectations and the switch between recession fears and the Fed flooding the market with liquidity, i.e. cutting interest rates, versus inflation being too high and them having to pause interest rates yet again in order to make sure that inflation doesn't, you know, get out of control. And so when we take a look at the target rate probabilities for the Fed meeting in just 4 short weeks here, we can see, and we've been talking about this for the past couple days, but we have now shifted to essentially a 50-50 coin toss between a 25 basis point cut and a continued pause from here. Now, this is a lot different from what we saw just from 1 month ago, whereas on October 13th, we saw that there was a 96% chance that they were going to cut by 25 basis points and only a 4% chance that they were going to pause. And so, as you can see, massive acceleration in the probabilities of a pause and a huge deceleration in the probabilities of a 25 basis point cut. And this is solely because of inflation expectations remaining stickier than expected. We can take a look at the Cleveland Fed's inflation nowcast, seeing that their CPI for headline for the month of November, which gets reported in the second week of December, that is going to be near 3%. So nothing really has changed since it was reported all the way back in August, the August print that was reported in September. And so if inflation isn't coming down, then the Fed's not going to cut interest rates, even if there is a continued slowdown within the labor market. And that's a big decision, something that the market was not necessarily prepared for. And so you're getting that imbalance right now. And so with that, with those expectations changing, as well as the fact that, you know, other type of Fed governors have gone on TV and said, hey, you know, because of us ending quantitative tightening, this is not meaning that liquidity is going to be flowing, right? Just because we are then buying, using our principal from expiring mortgage-backed securities to buy treasury bills in order to maintain the market liquidity of where it's at, that is not an injection of liquidity at all. And so it was also a firm narrative destroyer by the Fed itself, saying that, hey, this is not something that we're doing in order to stimulate the markets. This is merely because we have ran out of ammunition on the reverse repo facility. And so, yeah, I mean, just like in a video game, if you're running out of ammunition and you're trying to be more resourceful, it's a little bit harder of a game. And so taking a look at something like Bitcoin, it's been realizing this, which, really Bitcoin is a fantastic macro indicator for liquidity conditions. And Bitcoin is about to close here on a new low below $100,000. We have not had a close around here since May 6th of 2025. And yeah, taking a look at Bitcoin here, not the greatest look in terms of what Bitcoin's price action is doing at the close of 2025 here. And if we take a look at the percentages here, let's just see what it's done so far year to date. So far year to date, Bitcoin has only performed plus 5.16%. Let's compare that to the S&P 500 here. SPY. Compare that to the S&P 500 in blue here, which is up over 14%, nearly 15%. So you're getting 10 extra percent by being exposed to just the stock market than Bitcoin. That is not a good year for Bitcoin, or something that was expected by the cryptocurrency community, which is why if you're somebody who is more exposed to cryptocurrencies, I would highly recommend that you start incorporating macroeconomics and paying more attention to these types of liquidity dynamics. Because if you understand that, as well as the rate of change of how this liquidity is changing, that's what's going to help position you best within the cryptocurrency markets. And so our model went bearish on Bitcoin a few weeks ago and has maintained that bearish trend, and that has not changed at all. And so when something is in bearish trend, our policy is just don't own it. Wait for it to regain trend strength and signal to you that it's going to go back to bullish trend, which it's not doing that just yet. But that's okay though, because just because Bitcoin is not in a bullish trend does not mean that there are other things that are not experiencing a bullish trend, mainly healthcare, which right now healthcare is the most bullish sector in the S&P 500 currently. Taking a look at the healthcare ETF XLV, we can see that since August, it's had a massive acceleration here. Let's take a look ever since August 8th, which is my mother's birthday. It's up over 18%. So that's a pretty big shift. And so if you're able to recognize this transition here, then you were able to shift a lot of your capital from those highly liquidity sensitive risk assets, such as cryptocurrencies, such as quantitative or quantum computing stocks, such as some of those AI speculative stocks, into more defensive sectors like healthcare here. And really, healthcare is the only thing today that isn't down. We can see that tech is down. Discretionary had a huge down day. Lots of things are breaking trend. And so when you see something like this, this is also a large signal that we could be seeing a fundamental shift in the macro itself. Now, again, that doesn't mean that other things, that doesn't mean go all into cash and that, we have to give up and hang up the towel. No, we just have to make sure that we are owning bullish trends and not owning bearish trends. One thing that is in the top 10 stocks according to market capitalization is Berkshire, BRK.B. That has since had a huge rebound from the beginning of November lows and had a pretty big switch up here. And so, as we know, Berkshire, they've put a lot of their cash and funds into things like treasury bonds and things like that. And so it's more of a defensive positioning. And so with healthcare as well as Berkshire performing well, while at the same time we also have a bullish dollar, these are all signals that liquidity is tightening and that you want to be a little bit more prudent and not just all the way out on the risk curve. So that is really what we are seeing here in the markets. Interesting as well with the strength return of things like gold as well as silver. Those names are having a little bit of a correction here, taking a look at gold. And so what I want to be looking for is a slower volume day with this retracement, which we're kind of getting that right now. Maybe we'll see another day of correction here where it might present a buying opportunity for something like gold. But yeah, this has since regained its trend over the past few days, signaling a more stagflationary environment with more sticky inflation, as well as slower or stagnant growth. So that's one thing that I'm looking at here in terms of an opportunity. I have not added to it just yet. And so the market closes in about 3 minutes here. We want to see how the VIX closes. If it closes above 20, that would also be more of a higher risk signal. So we'll see what happens there. This was attempted on November 7th, and it didn't quite close above 20. And so that's what provided a good buying opportunity. So we'll see what happens here. There are still a lot of bullish trends that have not broken those bullish trends. So, this is a pretty good buying opportunity day for things that remain in bullish trend, that are having some lower volume, and that are having a little bit of a down day. And so for those that are in our macro investing community, you guys know which ones those are, as we provide actionable call outs every single morning before the market opens up on what we have our eye on for the day. And so I would just reference those there for those that are in our community. And so it's not just inflation expectations from places like the Cleveland Fed or the futures market when looking at the target rate probabilities for the December Fed meeting. If you take a look at the 5-year break-even inflation rate, which is the bond market's way of pricing in future inflation expectations, we can see that that has also had a rebound from the end of October lows. And if we take a look back, this really has not changed since November of 2024. So, there's been periods of highs, periods of lows, but really it's maintained this 2.37 to 2.4% over the past year. Essentially, we haven't had much progress on inflation continuing to come down, and it's remaining sticky and well above the Fed's 2% target. And the Fed was expecting that this wouldn't be happening. And again, it's that divergence there that's really causing the markets to say, hey, we may not be getting rate cuts for an even further time than we thought. And so because we're not getting the sugar high of the Fed cutting rates, it's going to be a little bit tighter. We are then going back through what's called the stop-go cycle, which is something that's, I was talking about yesterday in yesterday's live stream, but I do have this pinned to my X account. And so essentially the way that this works in this no landing stop go cycle that's been going since 2023 is that right now we are in this stop phase, which is where we're transitioning from higher inflation expectations to now a more hawkish Fed, a rate pause, stocks drop, and we have hard landing fears. And so as soon as, and this goes all the way back to 2023, this is the continuous cycle that we've been in. As soon as inflation expectations start to drop and we get a more dovish tone finally from the Fed, then that has typically been more of a buy some type of scenario before it goes back into a go phase, which is where, hey, inflation has come down. Maybe we can start talking about being a little bit more dovish, continuing our rate cutting regime. Hey, stocks like that then it has a bounce. And then we get more of a soft landing optimism because, hey, the market's not the market's not crashing, and we're going to get rate cuts soon. Soft landing optimism comes back into play. And that continues to happen until inflation expectations go higher again. And then we go back into the sell some, which is normally what we've seen as a good time to take a little bit off the top. And then we go back around in the stop phase. And so this is really what we've been seeing since 2023. And it will stop when a hard landing happens. Now, don't ask me when that will happen or at what magnitude that will happen. You're asking me to rub a crystal ball and make a prediction, which making predictions might sound great on other YouTube channels that are just trying to, sell you some type of hype. But on this channel, we want to stick to more realistic expectations. And so with that, we don't know, we're okay with admitting we don't know when there's going to be some type of recession or a major slowdown or a break in the economy. And we don't know at what magnitude that will happen, but we're just going to continue, as long as things are maintaining bullish trends, we are going to continue to own those until the market says otherwise. A lot of people think that they're just going to wake up one day and the market's going to be down 50% and the world's going to be ending, which that's very unlikely. Not entirely impossible, but extremely unlikely when looking at history. But typically, from what we're seeing, if you're paying attention to macroeconomic types of signals, such as the bond market, credit spreads, things like that, those will actually give you a little bit more insight into what's to come. And so, one thing that my team and I like to pay attention to is credit spreads on TradingView here, which is this crazy ticker that you can just take a screenshot there and put into your TradingView. But typically, when this starts to have a spike, or at least goes back into a bullish trend, that's when you want to be really more defensive and get into more things that won't give you, crazy exposure to risk on assets that have a high risk of going down. And so, to give you a better visual of this, I'll have credit spreads where they're at, and I will invert this chart just so that you can see it right here. And then I will overlay the S&P 500 ETF SPY just so that you can see exactly how this has been able to, help specific confirmations, right? And so as you can see here with this inverted, you can see that credit spreads really started to widen and confirm, as well as on that dip there that we saw back at the end of February of this year. That really started to have a crash a little bit ahead / coincidental with the S&P 500. And so it's one of the confirming types of signals that we like to look at. And so once this went past this 3.5 level, that's when you kind of knew, like, hey, this is a pretty large risk off type of environment. And so zooming in right now, we can see that there is a little bit of that, hesitation. And so if you really start to see a spike in credit spreads here, where you start to see this go down, then that would be a pretty big confirmation with potentially seeing a larger drawdown in the S&P 500. But if it maintains its bearish trend for credit spreads, not the S&P 500, if credit spreads start to come down, then that's actually a good signal of that there isn't going to be major concerns. So make sure you guys are paying attention to that, but it's just one of the many things that we track in our community here. So yeah, that's pretty much all I have for you guys here today. Nothing too crazy in terms of the macro data coming out, since we didn't get CPI data. But I guess what we can also look at is the yield curve currently, which has been in a bull flattening for quite some time. Let me go ahead and actually zoom out on the 3-day chart. That way we can see this bull flattening in action here. And so, as I've talked about before in previous live streams, the way in which the yield curve here is going to re-steepen is going to tell you everything you need to know on if we're going to go back into a full-blown risk-on cycle versus some type of risk-off cycle. And so really we're just in a period of the calm before the storm. And so typically what happens in these later stages of the business cycle, whenever we have a bull flattening like this in the yield curve, is we have what's called a bull steepening coming out of this, which is where the low or the short end of the yield curve is dropping faster than the long end of the yield curve, which is typically a signal that the Fed is cutting rates aggressively because something has broken in the economy. And so we saw something similar during the crash that we saw during the tariff tantrum this year. See this huge spike and how the background is green right there? That's the way that we signal a bull steepening. And so if that happens, then we could see another decent sell-off in the markets. But we're not seeing that just yet, right? We're not seeing a huge spike. And so, these are things that we want to be paying attention to for early indicators. But if we continue to see a correction without this happen, then that would probably mean that it's a good time to, take some risk there and buy the dip. So that's only in bullish trends, right? I'm not saying buy the dip in bearish trends like Bitcoin. Only in bullish trends. If something's bullish and it has a correction and is maintaining its trend, then and only then is a good sign to buy the dips there. But yeah, not all dips are created equal, as you may or may not have experienced yourself in your portfolio. But yeah, that's pretty much all I have for you guys here in terms of the macro data here. But we can go ahead and get into some of the questions and comments that you all have left in the comment section here. Let's go ahead and go over to YouTube. All right. Phil Card asks, do you think we'll see inflation continue to follow the chart pattern from the 70s? It's virtually identical over the last few years, would mean a huge spike in inflation over the next 2 years. Yeah, and so it is a little bit similar, but the thing that happened that was the main contributor to the 70s inflation was the huge spike in oil prices due to supply, and we're not seeing that right now. Right, a lot of the supply, a lot of the inflation that's happening right now is more so due to supply constraints on more of the price side of things of goods as well as services. It's not really being brought to us by a supply constriction in oil. So I don't think it's something that is necessarily identical to the 1970s inflation. I think this is more so a product of tariff inflation, as well as just an entire labor market that has shrunk. So I think productivity has really gone down in the United States. The birth rate has obviously dropped. When you have a smaller population as well as a tighter labor force, then that's going to keep prices higher. As well as at the same time, if you're putting on tariffs on select goods that affect other types of services, then, services inflation is going to remain higher. And so, I do think that inflation will start to come down in the next year or so. But with this maintenance around 3%, I don't think that we're going to have a round 2 of inflation where it's going to go back up to, 9% inflation like we saw in 2022. That was mainly a product of the pandemic. But it's a great thought, but I don't think it's going to be identical to 1970s inflation. So, but great question though. Let's take a look at some of the Instagram comments here. How can I learn about macroeconomics? Well, you can start with just looking at YouTube videos. But if you're trying to learn macro in the context of the markets and investing and strategic positioning, then I would highly recommend taking a look at our 6-week challenge that's going on right now. And so if you take a look at the link in my bio for those that are on TikTok or Instagram, or if you are on YouTube, you can just go to the description below. But we essentially have a 6-week challenge where you gain access to our partnership circle, our trainings, everything like that. It's essentially for free for 6 weeks. And then, after that, you can see if it would make sense for you to join our research community full time at that point. But in order to gain more information about this, just go ahead and click on that link and then book a time with me on my calendar. And you can meet with me, actually me, on the call, and we can go through some of the details there. So I've already been talking to a lot of you who have been joining. So we're really excited to see a lot of people learn this and apply it themselves and contribute to the community. So if that's something that you're interested in, learn more by booking a call with me. Rob Monaco 12 says, join his community. I appreciate that, Rob. Is there a correlation between gold and the S&P 500? We can actually quantify that by looking at the actual correlations here. So let's go ahead and go to, let's go here. All right, let's take a look at the correlations. Let's fix this chart here. Okay. Now this is showing the 30-day rolling correlations versus the S&P 500. And right now, let me zoom in a little bit here. Actually, that might be a little bit too much. All right, so as you guys can see, hopefully you guys can see this, but gold is in blue, in dark blue here. And what have you seen the correlation between gold and the S&P 500 do over this 30-day trend? You've seen the correlation actually decrease from, all the way back at the beginning of October when it was nearly a 1-to-1 positive correlation, meaning if gold went up, the S&P 500 would go up. Now we're actually seeing that correlation diminish, whereas as gold is starting to regain its trend strength, we're actually seeing a slight negative correlation with the S&P 500. It's near neutral, but you are seeing that decreasing correlation. And so we just have to see if this is maintained. What we can do is we can also zoom in on the 15-day basis, which will be a little bit more zoomed in here. And looking at it from gold on a more shorter term duration, there's actually a neutral trend between gold and the S&P 500. It was a complete opposite trend at the beginning of November, but it's near neutral on a 15-day basis. But yeah, on a 30-day basis, which is really the sweet spot, that is continuing to decline there. And so really the most bullish trends, or the most positively correlated trends versus the S&P 500, is actually commodities and then emerging markets, which is interesting considering a bullish dollar is happening right now. So that's a great question. But when it comes to correlations, it's one of the most important things to pay attention to. And I don't see enough people looking at correlations. And so, yeah, it's definitely helpful to track those trends. Now, this indicator right here is something that my team and I built, and you'll have access to if you join the 6-week challenge. But there's some other indicators that are like this, but this is really kind of giving you a nice visualization of correlations over time. Good question. Seems like the SPY was getting close to breaking its bullish trend. Do you agree? No, it's not really getting close at all. It's still maintaining its bullish trend, actually. So let's go to the SPY real quick. Change this to candles. Yeah, so I mean, it did have a decent spike in volume. And, it's a sign that a trend might be starting to change here, but it still is maintaining its bullish trend. So what I don't like is how the S&P 500 did have a bounce over the past few trading days on lower volume, and then volume came back just on a really big red day like we saw today. Now, typically that is a sign that trend strength is losing. And in that type of environment, you want to have your antenna go up to say, hey, is this a new trend shift, and how do I approach it? If you are someone who just plays the SPY, then what you could do is, and I'm not telling you what to do because I can't give direct financial advice, but according to our process, if you were to add to this, it wouldn't be a huge position because we're seeing more of a bearish signal with accelerating volume on a price decline like we saw today. When taking a look at the trading range model with the S&P 500, we could see that it did not reach the low end of the trading range. So as you can see, the low end of the trading range zone that we had for today was between $665 and $661, which tells me that there could be room for a little bit more downside here. We'll see what happens tomorrow. But it could be a good chance to add if it gets down to that lower point. And we also want to pay attention to correlations because things that are positively correlated to the S&P 500, like, certain select emerging markets that are in bullish trend, maybe you would want to only consider those if you also see the S&P 500 at the low end of the trading range. But yeah, what I would like to see is maybe we get another red day in the S&P 500 tomorrow, but it's on lower volume. If that happens at the low end of the trading range, that is a stronger buy signal. But only time will tell. We'll see what happens tomorrow. But I did not like how we had a bounce in the S&P on lower volume, and then we just had this red day on higher volume. That's not really the trend that you want to see. Good question, though. Good question. Do you expect quantitative easing to accelerate in the next few months? Do you feel that devaluation of the dollar will continue? All right, so the question was, do you expect quantitative easing to accelerate in the next few months, and do you feel the devaluation of the dollar will continue? Well, the devaluation of the dollar will always continue because our government is addicted to printing money, and that's part of the way that they are dealing with their debt problem is by debasing the currency and inflating away the debt. So that's a given, but it's the rate at which that's happening. And so quantitative easing is a mechanism by the Fed, which that speeds up that process by flooding the market with liquidity. But that only happens when there's a large break in the economy, which the Fed as well as the government are working together in tandem to try and avoid to the best of their ability. And so I think right now we're just going to try and maintain the liquidity levels that are there, which are considered ample, but we wouldn't be adding or going full-blown quantitative easing until something breaks in the markets. And when that happens, in the short term or in the immediate term, you could see a decent sell-off in the markets, just like how we saw during 2008, during 2018, as well as in 2020. And so, yeah, the devaluation of the dollar is always going to continue, but we won't go into full-blown QE unless something breaks. Now, I could see that the Fed starts to add assets on their balance sheet at a slower pace if liquidity levels get below that ample reserve level, but we're not seeing that currently right now. But I would expect them to, at some point in the next year, start to add assets on their balance sheet, but they're going to try and do it at a very slow pace, not to reaccelerate inflation. So it's a very delicate balance in this late of stage of the business cycle. And history has shown that the Fed and the government have not done a good job with this balancing act. It's not impossible. They have done it before, like in 1992, but there are more examples in history than not of them failing this balancing act. And so I do hope that they do pull it off, but I also want to stay grounded in reality to where if they don't do that, which is the higher probability of happening, that I have a strategy in place in order to protect my funds, which is the whole reason for paying attention to macro optics, or to macro optics, but macroeconomics in general. So good question there. Let me go over to the comments over here in TikTok, and then we'll go ahead and call it here. Let's see. Let me just scroll through these real quick. Sorry if I'm passing your comments. I'm kind of just filtering them out. Yeah, you can't see my screen because TikTok will not allow me to stream my screen directly on there for whatever reason. Hopefully now that TikTok is no longer owned by the Chinese, that eventually they'll allow people with a Mac computer to share the screen on TikTok. But yeah, for whatever reason, because I have a MacBook, it's not Mac friendly. So, yep, I am a Mac person. It's so convenient. It's so convenient. I don't know. When I was in 5th grade, that was the first computer that I learned how to type on. Okay, so it's kind of my middle school's fault, right? Don't blame me. I was brought up on Mac. All right, let's see here. What do you think about the recent sell-off in the markets? We already covered that. Just go on our YouTube and go back to the beginning of the show. Yeah, just take a look at that. Last question here. How do you foresee the tokenization of assets and the value of stocks? I don't know. We'll see what happens from there. Not sure. Let's see here. All right, actual last question. Do you think the Fed announcing the end of QT is a sell signal? Wouldn't they be out of the market before announcing that? Thank you. It's not necessarily a sell signal, maybe a take profit signal on select bullish trends that are maintaining its bullish trend, but no, it's not an outright sell signal. So, I wouldn't just jump the gun. We still need to see what happens from here because who knows? We could be in a period where the ending of QT is balanced well and that liquidity levels are maintained. We really don't know until it actually happens, right? So, yeah. But all right, everyone, I appreciate everyone for joining. We're going to go ahead and wrap it up there. Thank you so much. There's no stream on Fridays for tomorrow. And so we will be continuing back on Sunday's Sunday Macro Wrap-Up, which happens at 8 p.m. Eastern Time every single Sunday. I will be out of town this Saturday for a buddy's wedding, and so I fly back on Sunday. Hopefully there won't be any type of delays, but as of right now, we're still going to have the Sunday Macro Wrap-Up. But I am flying that day. You never know these days with the way that flights happen with cancellations, as well as how things are going to, with all the crazy flight cancellations that happen because of the government shutdown, what that's going to look like. So we'll see what happens, but I'll keep you guys updated. But I appreciate everyone for joining, and we will see you on Sunday. Good luck tomorrow. Bye.